Making sure I got all these screens doing what they're supposed to do. All right, so we start with the market watch. If you look at the top of your Thinkorswim, each one of these menu rows have their own parts and pieces. It's how you can find the things that you're looking for. Try breaking them down into menu groups. Get that alert out of the way. So there would be your first menu group. Underneath it, you have the next menu group. And then depending on where you're at in there, there could be yet another menu group. We just go to Market Watch, come to the next group down, we go to Calendar. We look at the calendar for today. Now, unless you're going to come in and trade in the evening, some of these events aren't going to be worth your concern. These 4:30, 7:30, 9:45, those aren't really going to affect your trading unless you're in the futures. But they can affect tomorrow's trading, right? So it does help just to recognize that they are there. That way, if you wake up tomorrow and things look really negative and you're asking, what the heck happened? Maybe one of these other countries had PMI numbers that their investors didn't like, and it toppled their market for the day. Sometimes we lead the foreign markets, and sometimes they lead us. Today, it's going to be job numbers again. Job numbers, job numbers, job numbers. Wednesday, Thursday, and Friday, these are the numbers. These are the things that are rocking our market out. So we want to be ready for this 7:30, 7:30, 8:30, 10, 10:30, 11, 11:30. The 11 and 11:30, these are additional auctions. There's always an auction at lunch. These are additional auctions. It's these kind of things that can kick a market out of a range and galvanize it into an actionable trading afternoon. They can also kill a trend, or they can reverse a trend. So it's worth learning a lot more about the lunchtime, just recognizing that there is such a thing as a lunchtime window, and that on some days when there are additional auctions, we won't actually expect price to stay in that lunchtime range. All right. I titled this morning briefing Higher Lows, because we are starting to finally see some higher lows. Yay. Maybe it's turning around, right? Just maybe this thing is trying to catch a little bit of support at these lows, perhaps base a little bit, and we could potentially start moving up. It's still going to require the job numbers, right? It won't matter what candle chart we can find, what patterns and setups, and it's a wedge, it's a head and shoulders, cup and handle. It doesn't matter if the job numbers suck. That pattern is going to collapse and everything is going to go down, right? Or actually, I think right now bad news is good and good news is bad. So if the job numbers suck, that's probably going to be seen as a positive. The numbers were good yesterday and it was seen as a negative, because it implies that they will have less interference or less complaining from people when they say, well, we're going to taper because we yet again have all these really good economic data points that say you don't need us to purchase all this stuff. We're going to dial back our tapering. So the good numbers yesterday were seen in a negative light. So maybe bad numbers will be seen in a good way, or bad numbers will be bad numbers and good numbers will be bad numbers. Aren't you glad you're not an economist? So we got some higher lows. We made it almost all the way back up to yesterday's price action yesterday. And we have the potential today for a trend day. Now, if you're looking at this and you're thinking, yeah, but dang, we're already up 94.94%, almost a 1% move already. That's true. But we are still primed for a trend day, right? Because when we get outside of the previous day's price range, and in this case, 2 days of price range. All the time that it spent in here was just winding up more and more and more energy. We finally broke out of that. It's smooth sailing, clear skies. There's nothing in our way until we get to this angular trend line. And that thing is, yeah, I mean, it's up there a little bit. You know, if we wanted to try to aim for that from our current location, we're looking at another 0.75% on top of what we already have. That would be a day of more than 1.5% move, perhaps a little bit more than that. That's not that bad in the grand scheme of things. We could easily make that range. We just not even an hour ago broke through this last level of resistance. There's some minors in here, places where we would expect price to test and deflect, and then give another run at it. You have to think about where there are trapped traders in here. When price suddenly leaves a range and catches people off sides, you'll get trapped traders. So think about anybody that was still holding there to the upside and suffered through all this mess. And I used to think, no way someone would do that. No way. Yeah, people do that, and they're still in it, and they're still trapped. We haven't come back up to that level yet since we left that area. You can bet, put money on it. You can bet that when we get there, there will be a reaction in the market. There is a pool of liquidity there, right? And people that are just going to be so happy to get out. They held through all that mess, and they're going to get out right where they got in, not even getting any profit, not even getting any reward for all that pain and suffering. There will be a reaction there. There won't be a reaction as much here because we revisited that range, right? When anybody was trying to go short and it went against them and all those shorts were trapped, when we got back there, they got the heck out. So that's not an area. This is an area of concern. This would be an area of concern. Anybody that went long up there and that are still in it, because we have not yet revisited that range. There is still a liquidity pool there. So that would be 44.20. In between 44.20 and our current location is 44.11. That's a COG. It's a cog line, the center of gravity. It is drawing price to it. When price gets to it, we expect it to stay there. It is gravitated to that point. It is way too in-depth to go through in this video. Just recognize that there is such a thing called a COG, center of gravity. And it's not John Euler's indicator of center of gravity with those crazy ribbons and lines and colors all over the place. It has nothing to do with John Euler's or his center of gravity indicator. It has more to do with the hedging activity and volume flow. So we have our upside targets for the day. 44.20 would be our first area of resistance. We get through that, we will deal with 42, and then we will deal with the highs and or this angular area of resistance. To the downside, if everything comes and starts to flip over, which it absolutely could do when the numbers come out. As positive as all this feels right now, it could all turn and flip, right? To the downside, we would revisit the Globex pivot of 70. Then this line here, go ahead and put one on with some numbers on it. 44, 55, 57, and then back on down through the lows. It's unlikely that we're going to make that trip unless the numbers are really, really off. If there's any ambiguity to the numbers, if they're kind of wishy-washy or a little bit flat, we're more than likely not going to see anything like that. The biggest thing right now would be surprise numbers. This happened like 2 months ago. Everybody had it all figured out, and then the numbers came out, and they were not just a little wrong. They were really, really wrong on their estimates, and the market reacted very violently to that. So other than something like that, I don't expect to revisit these lows. Even to make it towards that area, we have a lot of things in our way that we would have to get through. These are like barricades of price. For the NASDAQ, yeah, higher lows. Higher lows. Yes. Broke the trend line. Make this little micro cup without a handle. That's going to be our major support level at the moment. We really need to see that thing hold. If it doesn't hold, the roundy is the line in the sand, 14,800. That's really going to be a critical pivotal level if we do revisit these lows. Otherwise, we're continuing to head it to the upside. Major area of resistance. These two kind of tie together, so that's nice. We don't have to have a bunch of extra lines. It would be the angular trend line or the pivot point from 92, because there's a minor there. 88 is a minor, so we could call it 88. 92, either one of those would be fine. It's very, very close, and it lines up to the trend line. The trend line came from here, right? So the way Thinkorswim does it, if I draw and connect these dots here, when I start to go into the lower time frames, it just looks like that line is floating in the middle of nowhere. But that's the two data points that I connected. It is unlikely that we will hit these lines today. That's a tremendous move on top of what we already have moved, right? So it's unrealistic to believe that we're going to make that distance today. However, we're only up 1.25%. Be very careful of a gapped up market. I should have talked about this for a moment on the ES, but we're already here. So on a trend day, one of our days, one of those trend days where we have left yesterday's price action, and we are in the pre-market and we are gapped up a long ways. Most of the time, we open and we continue moving in the same direction. It would be a very bullish blast that the market opens, the bell rings, and without even attempting to go down to close that gap at all, that we just explode higher and continue to run all the way to lunch. On the other side of that, there are a lot of days where we have gapped up just like this, 1.5%, 1.25% in the pre-market. Everything feels super bullish. All the bells are lit up, and the bell rings and it starts to go down. That's the tricky part, because when we have gapped up, we expect red candles. Oh, it's only going down for a little bit to close the gap, and then that bullishness is going to kick in. So we're all trying to go long and trying to catch the V bottoms and catch the reversals and that thing will continue to go down all morning long. Seen it before, we will see it again. So as bullish as all this feels this morning, when we get into the open, if it does start going to the downside, yes, we want to catch the reversal. Yes, we can watch the AD. We can look for those signs to come in, but aim for the gap close. Aim for the gap close. Okay, so if it closed here at 757, or if we use the 5 o'clock close and say 771, I would just aim for the quarter, 775. If that's where we closed, when we open, we are going to attempt, or we should attempt, to see some form of a gap close. Okay, so if the market is going in that direction, trade it in that direction or let it soundly reverse. Don't think that you're so good that you can catch the bottoms. You ain't that good. You can accidentally, on pure accident, catch the bottoms sometimes or catch the tops sometimes. We all get lucky once in a while, and broken clocks are right twice a day. Don't think you can catch that bottom. Let it turn around and actually begin to move up and prove to you that that really is its last hurrah to try to close that gap, and then run it up from there. No big deal. What you don't want to do is continue to try to go long through an entire morning that just keeps going down. And for anybody who's traded futures, if you haven't done that yet, you will. It's happened to all of us at least once. Narrow-minded and narrow-focused without revisiting and asking the question, am I still right? Should I still be attempting to aim this direction, even though we were so crazy bullish as we came into the open? So we've had the dollar continue to fade. We've had a range-bound bond market, which is not necessarily a bad thing. Kind of zoom out here a little bit. Got this critical level, and we've got the strong level. So very strong level. It's held at the moment. If it breaks here, there's going to be a lot to think about. As bonds go down, interest rates go up. Banks love that. Technology companies do not love that. So we're in a little bit of a catch-22. We need banks and we need finance working together to have a good, strong, healthy market that continues to go up. If we only have one or the other, then we're hobbling or handicapping one sector that we really, really need. Right? And we can have one that isn't really performing and then one that is performing, but we can't have one that's in the garbage and then one that's doing really good. That bifurcation does not work. So the banks are going to love it. Tech is not going to love it. We're going to need to see that resolved in some way. It's not the first time we've ever been in this situation, so of course it will be resolved eventually. If, on the other hand, we rebound off of this strong level and we begin working our way back up, even first breaking this trend line, then as bonds go up, interest rates go down. Banks do not like that. Technology does like that. Catch-22 again, right? So if we go up, one side's getting hurt. If we go down, one side's getting hurt. Small, smooth, subtle price action is fine. What we're watching for is, oh, damn, did you see the move in the bonds, right? That kind of move. That kind of move is going to rock the market, and that's what we want to be aware of. So throughout your trading day, when you're watching the bonds, it's extreme, explosive moves that we want to be concerned about. And then when everything pauses and it starts to build a range, look for it to leave that range. When it's just hovering in there, it's not really providing any impact in our market. But if it was to break one side or the other, that would impact our market. So watch for those. Same thing with the dollar. Extreme moves in the dollar will impact our market. Slow grinds or holding the range, not so much. Now, I say that, but the notional value of what is traded and how the dollar is traded, it's not just traded this way. The notional value of this thing, as it begins to run, even small moves like this can cause extreme reactions in our market. Same with the bonds. But when it's testing against an area of support, watch for a drastic break, a huge dump in one direction. If it's pushing up against the resistance, be ready for that thing to break out. Because if it does, it's going to have tremendous impact on our market. Don't assume, by the way, that you know what direction it's going to impact our market. We assume most of the time that when bonds go down, stocks go up. Typically, that's true, but that's not always true. It's not a must-have. The sun comes up. That's a must-have. There's no argument about that. But stocks and bonds do not always go inverse of each other. So when we see the bonds and we see the dollar breaking in a particular direction, look for confirmation. If the dollar is getting ready to fall and you got the S&P pressing against resistance, then they're inverted today. But if you have the dollar about to fall and you have the ES against support and it's about to fall, then they're working in concert today. They're both moving in the same direction. Or bonds. If bonds are at their low and the S&P is at their low, if the bonds drop, it's very, very likely the S&P is going to drop too. But if this is at the low and the ES is at the high, when this dumps, very, very likely the ES is going to spike to the upside. Seen a very, very strange thing yesterday where the S&P and the VIX had identical charts. Not identical inverted charts. They were the same chart. That ain't right. Like, I don't know if you guys have seen my volatility school videos, but that ain't the way it's supposed to work. Right? You're not supposed to have the ES and the VIX with the same pattern. They're supposed to be inverted patterns. Right? Like, anybody catch that yesterday? Because that ain't right. It's a very odd market. Just be very careful. Right? Stuff like that shouldn't even be a thing. I don't even know. I don't even know what to do with it. S&P 500 filtered to 100 names, set to pre-market change. You can see it's lit up really well in the green, but we do have some very big names that are down near 1%. Charles Schwab, BlackRock. Oh, you mean those financial names? Yeah, those. That's a trading firm. There's usually a couple of trading firms in here, right? Usually it's like Schwab, CMG, or the CMG group. Maybe like a TD Ameritrade or a Fidelity. So typically it's not just one name, but Schwab, the trading firm, is down near 1%. But look at a lot of these names. Now, when we talk finance, we always have to ask the question, what finance? Credit cards, small banks, mid banks, large banks, insurance companies? What kind of finance are we talking about? I used to group them all together, and I found out that was not helping, right? It was actually making things worse. So you want to go in and identify when you're talking about finance, what kind of finance? Is it a trading firm? Is it a bank? Is it, a lending institution? Who do they lend to? Commercial lending or regular lending? Is it some form of lending to real estate? Is it credit cards? Right? So kind of follow that down the rabbit hole and you will have much greater success. The NASDAQ 100, no reason to filter. It is set to pre-market change, lit up really well, lots of green. There is some red. Texas Instruments is what I consider a chip name, even though, it almost doesn't even sound right. Like we think of AMD and NVIDIA, not Texas Instruments, but it fits in there. Now, the other day, these other chip names were doing really good. And it looks like they are again. MU, NVIDIA, Intel, AMD, all these chip names doing good. And then Texas Instruments. Like, what? Come on, you dog. What's up with you? But if all of the other names are positive, this one may be the one to trade. It may be the reversal, right? It's worth digging into, looking deeper. Why are all the other chip names good and this one's not? Could be something very simple like, oh, well, it had earnings and earnings sucked. But you want to identify that these anomalies stand out. You can find an opportunity to trade. The screener this morning, how many names in the NASDAQ are up at least 1%? 35% of the NASDAQ. I got to tell you, that's pretty bullish. That's pretty bullish. It's a good number, right? And if we swap this over to something like 25%, how many names in the NASDAQ are up at least 25%? 62% of the NASDAQ is up this morning. 62%. And when we come back over and we look at the NASDAQ and we say, well, what are those names that aren't up? Who's not doing good in the NASDAQ this morning? That would be an easier thing to actually look at because it's the smaller list. Texas Instruments, Inuit Software. Kind of try to, chase them down the line, follow them through to their conclusion. You can also turn it around and say, well, how many, out of the ones that are up, is there a particular kind of retail that is up? Is it some communications that are up? Where do we follow it down the rabbit hole? Now, yesterday I said we had to be stock pickers. We could not really lean on the sectors. Today you can. Today you absolutely can look at the sectors and find your trade ideas that way. Which sectors are up? Which ones are down? Which ones are up on the week? Which ones are up on the month? How many have been beaten down but are getting that reversal, that higher low that we were talking about earlier? Which one of these fits your account size, like the Jets or energy? There's a lot of energy names, less than $50 that are just great names to trade. And of course, cruise lines, casinos, those things have been beaten down. They're cheap, they're liquid, they're fun to trade. You can make good money on them. Find the sector that suits you, even if it's not an S&P sector, right? Like when we're talking about the EV markets. Well, there's not technically an EV sector in the S&P, right? You can't go to the S&P 500 sectors and find EV. Not technically. I'll show you a way. I can show you a way to do it, but still wouldn't be right. Right. So follow them down the rabbit hole. These are going to be your opportunities. We flip it over to the S&P. How many names in the S&P are up at least 25%? 64% of the S&P is up this morning, at least 0.25%. That's good bullish market, pre-market activity, right? It's good, healthy market participating activity. It just needs to hold, right? And the other side of that is when we come into the open, if we've already run 1% in like 35% of the S&P and 35% of the NASDAQ, if they've already made that 1% move, how many of them are going to continue to make yet another 1% move? How many of them are just going to open and kind of range sideways because they've already made their move? And that's something to be, thinking about. On the news, I don't hit through all of these. There's no reason to. But, there was Lordstown, NIO, Google, Robinhood had some pretty decent news coming out in the last few days. It looks like they're just trying to really pop anything out there that is positive, like a market waiting on a catalyst. In the weekly options list, since there are 600 names, I found it more appropriate this morning to just see how many are down. Less than a third are down. And of course, that makes sense because that's what we've been seeing in the S&P and the NASDAQ. But when we flip this thing around, we've got some names that are really, really up this morning. 5.5%, 4%, 3%. Some of these names are up significantly. A lot of them are up more than 2% this morning. And they're not like these unusual names. These are names with weekly options. Very liquid, very popular names. Some of them are really fun to trade too. Watch this, because these are going to be the markers that bring the rest of the market up. AD, trend. Look at the airlines this morning. Now, I'm a big fan of trading airlines, day trading, just because they're cheap and they're very liquid. EVs. A lot of news still going on in the EV market. Or crypto names, yet again. Some crypto is up this morning, and yet Bitcoin was down. But blockchain names, if there's still going to be fire there, if there's still liquidity there, may as well run it through. The chip names this morning. Right, so you can see how almost every single sector we go to is up this morning. Take advantage of this to go in and find the ones that maybe have not made the 2.5% to 3% move yet, right? The ones that its peers and its industry and its sub-industry have already made the move, but it hasn't yet made the move today. Those would be the ones that I would want to focus on the most. And then pair that with a daily chart, right? So you would come into the daily looking for an inside day or a bounce on the moving average, inside day breakout, an R to G pattern, something other than just, oh, well, it's up in the pre-market. Yeah, a lot of stuff is up in the pre-market. That's not a good enough qualification to make it to my watch list as we come into the open, right? I'd have a watch list of 1,000 names. But if I can find a set of names that have a daily chart that match my qualifications, that give me a greater than average expectation of a move, like those trendline breakover plays. The intraday ATR on a trendline breakover is 4%. 4%. We've caught it in Walmart. We've caught it in Target. We've done it in Facebook. You catch a 4% move on the day. It's a monster move, and you're able to see it coming as we come into the open. That's it for me. I don't want to come in here and kind of screw around with a 0.25% move on the day when it's already made a 3% move. I don't want it. So that's what we got this morning, guys. Be careful. Watch the clock. And I will see you all at the Bullish Bears.